Welcome to the September housing market update from CoreLogic RP Data. This month we take a look at housing market trends through to the end of August 2015. We saw the rate of value growth slow down in August after the CoreLogic RP Data indices reported a solid bounce in dwelling values over the previous 2 months. Across the combined capital cities index, dwelling values were 0.3% higher over the month and 5.3% higher over the past 3 months. Sydney's housing market was again the standout for capital gains, with dwelling values across Australia's largest capital city rising by 1.1% over the month to be 17.6% higher over the past 12 months. Adelaide and Darwin were the only other capital cities to post a rise in dwelling values over the month at 0.7% and 0.3% growth respectively. Melbourne and Brisbane dwelling values remained flat in August, while values across Perth, Canberra and Hobart all dipped by more than 1% over the month. The trend in value movements is arguably much more important than the month-to-month movements. Over the past year, we've seen dwelling values rise across every capital city apart from Darwin, where values have moved 4.6% lower, in Perth, where values have moved lower by 1.8%, and Canberra, where dwelling values slipped by 0.9% over the year. Sydney's topped the list for growth, with values increasing by 17.6% over the year. Melbourne dwelling values are up by 10.6% over the past 12 months, while Brisbane values are 3.9% higher, Adelaide's seen values rise by 1.8%, and Hobart values are up by 1.5%. The August index reading from CoreLogic RP Data highlights the diversity in the housing market. While Sydney and Melbourne values have surged by 7.4% and 8% over the past 3 months, 4 of Australia's 8 capital cities have shown a fall in dwelling values at the same time. The difference across each capital city market reflects the fact that economic conditions are just as diverse as the housing markets. As the market moves into spring, we're expecting a strong rise in stock levels as vendors seek to list their properties as the weather warms up. The market generally sees a rise in new listing numbers of around 25 to 30% compared with the winter months. The spring ramp-up in listing numbers is already well underway, particularly in the markets where conditions are most buoyant. New listings are already 18.1% higher compared with the same period a year ago in Sydney, and newly advertised properties have moved about 10% higher in Melbourne and 2% higher in Brisbane, and they've surged by more than 18% higher in Canberra. Higher listing numbers will provide prospective buyers with more stock to choose from during the spring season and will also provide a timely test of housing market conditions in the face of higher effective supply levels. The housing market moves into the spring season with typical capital city homes selling in just 37 days on average, which is close to a record low. Properties are selling the fastest in Sydney at just 25 days, and in Melbourne they're taking 35 days, while properties generally remain on the market for more than 3 months in Hobart, Perth and Darwin. A similar trend is evident in discounting levels, with vendors in Sydney discounting their prices by an average of just 5%, while in Darwin, Perth and Hobart, discounting rates are above the 6% mark. Auction clearance rates have dipped a little during the winter months but remain high on a historical basis. Over the first week of September, the combined capital clearance rate was recorded at around 75%. That's down from the autumn high of 82%, which was during the last week of April. With auction numbers set to increase during the spring season, it will be a really timely metric of market conditions to monitor from week to week. Let's take a look at the housing market conditions across each of the capital cities. Sydney's market continued to record the strongest capital gain results throughout the month of August, with dwelling values up 1.1% over the month and 7.4% over the past 3 months. Sydney values are now 17.4% higher over the past 12 months, and over the growth cycle to date, values have increased by 49.5%. In a sign that conditions may be starting to cool slightly, auction clearance rates have been drifting lower across Sydney, recorded at 78% over the first week of spring. Listing numbers have also started their spring climb a bit earlier, with a number of newly advertised properties entering the market 18% higher than a year ago, while the total number of homes available for sale across Sydney is still 0.5% lower than at the same time last year. The rate of capital gain flattened out across Melbourne over the month of August. However, with the CoreLogic RP Data Index 8% higher over the past 3 months, Melbourne has actually recorded the strongest rolling quarterly rate of capital gain of any capital city. Similar to Sydney, auction clearance rates, which are an important timely indicator for the Melbourne market, have tailed off during the winter months and registered a clearance rate of 76% over the first week of spring, which is roughly the same level of clearance as a year ago. At the same time, new listing numbers have moved about 10% higher than a year ago across the Melbourne marketplace, indicating that vendor confidence remains high as the market enters the seasonally strong spring months. Capital gain conditions were flat in Brisbane over the month of August, and dwelling values have risen by 2.2% over the 3 months to the end of August. Brisbane remains the third best housing market across the capital cities over the past 3 months and over the past 12 months, with dwelling values now 3.9% higher over the year. Most of the growth across the Brisbane housing market has been confined to the detached housing sector, where house values have moved 4.3% higher over the past year, compared with a 0.5% gain across the unit market. Due to the lower rate of capital gain, Brisbane rental yields remain substantially higher compared with the other large capital cities. The typical Brisbane house is providing an average gross yield of 4.4%, and apartments are providing a gross return of 5.4%, both of which are the third highest yields across the capital cities. Adelaide's housing market recorded a 0.7% rise in dwelling values over the month of August, but values were virtually flat over the past 3 months, down 0.1%. With the annual rate of growth at 1.8%, Adelaide's recorded the fourth highest rate of capital gain across the capital cities. Adelaide is also one of the few capital cities to be recording an upwards trend in transaction activity, with the number of home sales over the past 6 months 7.3% higher compared with the same period a year ago. In Perth, dwelling values fell once again over the month, down by 1.3% in August and down 1.5% over the past 3 months. Conditions are clearly softening across the westernmost capital city, with dwelling values down 1.8% over the past year. Transaction numbers are down nearly 14% over the past 6 months, and listing numbers are nearly 18% higher compared with a year ago. Despite the slowing condition, Perth remains one of the better performing capital city markets over the long term, with dwelling values showing an annual rate of capital gain of 5.1% over the past decade. Local conditions are likely to remain relatively soft over the remainder of the year as the local economy continues to transition through the downturning of mining-related investment. Hobart's housing market conditions remain relatively stable. Although local values were down by 1.1% over the month, dwelling values are 1.7% higher over the rolling quarter and 1.5% higher over the past 12 months. House values appear to be driving some level of growth in the Hobart marketplace, showing a 1.7% rise over the past 12 months, while unit values are down by 0.6% over the same time frame. Rental yields are well above the average in Hobart, with a typical house recording a gross yield of 5.2% and apartments providing an average gross yield of 5.5%. Darwin's housing market recorded a slight rise in dwelling values over the month of August. However, the trend in conditions has been negative, with dwelling values down 3.2% over the past 3 months and 4.6% lower over the past year. Buyer demand has shown a sharp downturn as well, with the number of home sales now 15% lower compared with the same time a year ago. Canberra's housing market has started to level out after conditions deteriorated post-federal election. Local dwelling values remain 0.9% lower over the past 12 months. However, apartment values are now 0.9% higher as stock levels continue to be absorbed and rents start to once again rise. New listing numbers are also starting to ramp up as vendors gain confidence in local market conditions. With the housing market now into the spring season, we're expecting to see the number of homes being advertised for sale accelerate higher. The higher number of listings represents an opportunity for buyers with a wider range of stock to choose from, which may reduce some of the urgency in the rapidly selling markets such as Sydney and Melbourne. The higher stock levels will also present the marketplace with a timely test of its resilience. Will buyer demand rise to meet the highest stock levels, and will auction clearance rates maintain their place around the mid to high 70% mark across the combined capital city weighted average? The low number of homes available for sale in Sydney and Melbourne has been one of the key drivers of the strong capital gains in these cities. So it will be interesting to see if the higher stock levels work to dampen the higher rates of capital gain that have been very much evident during the first half of the year. The first week of spring saw auction clearance rates remain high on strong volumes. So if the early indicators are anything to go by, we're in for a vibrant spring housing market. Interest rates are set to remain low for the foreseeable future, which is likely to keep a base level of buyer demand in the marketplace. Mortgage rates haven't been this low since the 1950s. On the other hand, there's likely to be increasing focus around the level of investment lending to the marketplace. Growth in credit-related housing investment is rising at 10.8% per annum, which is outside the APRA guidelines of 10%. So we can expect investors to face tighter lending conditions as lenders aim to comply with the APRA regulations. It should be noted that in June, investor housing credit rose by 0.6%, which was its slowest monthly increase since October 2013. Perhaps this is the first sign that investor finance is starting to soften. Overall, the moderation in the rate of growth across our combined capitals index to August is likely to be viewed as a positive development by the Australian regulators, such as the Reserve Bank and by APRA, who have been highlighting concerns about the strong rate of value growth across Sydney and Melbourne. Of course, it's only 1 month, and it will be important to see whether or not the slowing trend will persist, particularly as we head into the busy spring selling season. Once again, thanks for tuning into our housing market update. For more information on your local housing markets, you can visit our corporate website at www.corelogic.com.au or check out our latest housing market trends at propertyvalue.com.au.